Okay, let's start this one. Okay,
Okay.
we're good. Just bit the background. Okay. So let's go back to our job here, which is the case. So the company, Brian McGregor is the owner. He owns 40%. The VP Finance, VP President bought 25, and the other two. So that's probably not for us. Brian is 68 old and wants to sell his shares. So there we go. That's why he wants. Once he sold, wants to. So listen, every time when you see something like this, that's a problem with the assurance. Every time somebody wants to get out, that means he will be willing to on the manipulation of the increasing the revenue, showing more revenue. Why? To increase the market value of the company so he can sell it to get more money. Right? Every time when you see something like that, a statement like this, you have to be like a red flag right there for the assurance.
Okay. Yeah.
Right? You can easily say it as a risk increasing of the audit risk. Right there.
Okay. Yeah.
2021 issue bonds for the private investors. That's so once you see issue bond for the private investor, those are the users of the financial statements right there, which is on your audit plan. If you have to the audit plan and go with the materiality, first you have to identify the users of financial statements. So you have Brian, he will be interested in financial statements. A bond issue private investor, Jefferson Investment also is going to be using the financial statements. He has expressed interest in purchasing share of CPN and will use the financial statement to determine the offer price. There you go. Now we have even extra pressure on us as auditors. Why? Because this particular person, he's going to chase this particular thing. On October 21st, Suzanne, whatever that controller, resigned for personal reason. There you go. That's another risk. Right there. In October 2021, just before the year end, our controller resigned. Excellent. That's awesome. I love it. I just love it, right? what the perfect time to resign. Actually, the perfect time to resign probably is January the 5th, right after the year end.
That's scary.
Yeah. So that's the other thing. Her role has not been filled yet. That's another control risk probably. And the accounting department is currently short-staffed. There you go. That's another. All the red flags are in few sentences. Now let's go to see our rows and what's on our row. So for our row, what I'm going to do, the same trick like before, copy it, paste it in the Word document and move to the Word document and do it there. That will be the best. Because on the Word document, we can highlight and do whatever we want to do. See how it's going to fit. Okay, so now we can move to the Word document. Stop sharing this and move to the Word document. That's the Word document. No, that's not the Word document. That's the original document. What am I doing? This is the Word document. Right? So requirements, you, CPA, are a manager at Franklin Arrington Chartered Professional Accountants. This company auditor, Kylie Vera, is the auditor engagement partner. We're the manager, she's the engagement partner. Jonathan asked you for assistance, so asked for assistance with some task related to budget cost prices. That's more likely managerial accounting. Budget cost pricing, that's managerial accounting. Kyle,
Mm-hmm.
Kylie, the engaging mortgage manager, advise you to that the work you perform on those tasks will ultimately be reviewed and approved by the management. And she has handled the independence and conflict, and she has handled the independence conflict of interest consideration based on this. Okay, she also asked you to discuss, so we have to discuss accounting treatment for inventory, one, for the Kingston University contract, two, and for the joint arrangement with this guy. And now we're going to the next paragraph.
Yes.
So here we have 1, 2, 3,
Mm-hmm.
4, 5, 6 right there. Well, she has, let me see, Cal advise you that your work performed on this task will ultimately be reviewed and approved by the management. That doesn't look like a requirement for me, just additional information. So ask you to prepare. So now you have to prepare an audit plan. There we go. Audit plan for December 31st, 2020, year end, and to recommend audit procedures for the accounting issues, which are, let's see, which are the accounting issues? The accounting issues are accounting issue 1 and 2 and 3, right? If we have to label it this way.
Mm-hmm.
Right? Accounting issue 1, inventory, the Kingston contract, and joint arrangements. You discuss. As well as, okay, newly constructed warehouse. On top of that, we have one more. So that will be audit plan 1, recommend audit procedure for accounting issue 1, 2, 3, 4. She also wants you to explain any risk you identify on the safe sales cycle. So first we're chasing risk.
Yeah.
On the safety cycle, on the sales cycle.
Yeah.
And then we have to provide, here another one, provide audit procedures for each of those risks. And the last thing to describe, we also have to describe any additional information required. So that's become like a explain risk, you identify the sales cycle, provide audit procedures, and describe additional information required. So, walkthroughs of sales, purchase, and payroll cycle were completed as part of the interim fieldwork. The internal control was found to be operating effectively and were consistent with those relieved upon during the prior audit, except for the children's books vision. So this is our problem here, children's book vision. Next paragraph, we're going. Karen would like you to discuss, there we go, another one, whether it will be appropriate to use work of CPA internal audit department. Can we use this one? And describe, that's another action verb here, describe. Any procedures that we'll need to perform to be able to use their work.
Mhm.
The department was established July 2020 and led by the Chief Audit Executive Belvin Alexander, who is CPA and Certified Internal Auditor. Belvin was Audit Senior Manager of the accounting firm before he joined the company. Reports functionally to the Audit Committee and administratively to the CEO. And that's the paragraph. Give us some background for this company. So basically, the audit team means he has the credibility to do it, right? Obviously.
Mhm.
So that if we have to discuss the risk, that will be one thing that's gonna lower the risk. At least he has the qualification. It's not like somebody from nowhere leading this committee. As FE will provide a management letter to CP, I'll ask you to discuss. Here we go. That's another action verb here for us. Any weaknesses in internal control. But that's very specific to identify in the children's books division.
Division. It also becomes an audit risk in approach, right? Because we've already been told their weaknesses
Right.
in the planning and whatnot. Do we have a plan for this one? No.
No. Weaknesses, only weakness. Discuss any weaknesses in children. So here, all the audit internal control was found to be operated effectively, except for the children's book division, and the children's book division here come. And then we have to recommend any improvements, right? In addition to the common appendixes, 1 to 4 additional provided for assurance in the relative to you analysis. So what we found here, prepare audit plan. That's number 1 for us for audit, right?
Mm-hmm.
That's 1 for audit. Then to recommend audit procedures on the accounting issue, on the newly 1, 2, 3, 4, right? Audit procedures. Here we have 2, 3, and 4, and we have another one newly warehouse. That's 5. Also explain that's number risk. That's number 6 here for us. And you identify sales and provide the audit procedures for those risks. That's number 7. And describe any additional information required. That's number 8. I'm gonna go crazy with those numbers, but walk to internal control was found to operate except in the children operate effectively. There's not any requirements here, just information that doesn't work well in the children book. To discuss, that's number 9 here for us. Whether to use appropriate work and describe, that's number 10. Any procedures that will be and discuss, that's number 11. And identify children and make a recommendation, and that's number 12. Most likely here will be identify and recommend will be one assessment opportunity, but let's clearly separate them so you're not going to miss anything. Make sense?
Makes sense. Yeah.
Right? Bring it, if you can bring it to the more pieces which are part of the big piece, that's even better. But I want you to see every single activity that you have to do, right?
It seems like a very short case.
It looks like a very short requirement.
But it's actually a bit bulky because they put in a lot of managerial
Yes,
compared to most cases I've seen. In this one, they have a lot of managerial and just
right. Yes,
yeah.
that is true. So from here, let's go to the common. Where are our common here? And that will be page 43. I can move now to the case. Page page 43. So, publisher typical edit, and this is the information. So, publisher purchased the rights for the auditor works and agreed to pay royalty fees up to 1/3 projected royalty in the first print batch may be paid in advance. Okay, competition. The industry is consolidating includes 4 large, well-established publishers who combined hold a high percentage of the market share. They have resources to aggressively market their product and control the distribution channels. Competition is based on price, brand recognition, and marketing. Some publishers have reduced cost and increased the revenue by outsourcing their sales function. Some of the firms performing this sales function represents multiple publishers and have considerable bargaining power with the retailers. However, some retailers have refused to work with those firms, citing aggressive sales tactics and declining services. Profit margins. Key success factors is ability to predict which topic and author will be the top sellers. For print and for both print and ebooks, publisher aim to put for the net profit margin be around 10%. Because ebooks have lower selling price, the weighted average selling price for a specific title decreases as the proportion of sales of the ebooks is printed book increases. All books can be published as print only, digital only, or both. Historically, children picture books and books for very young children were very predominantly sold as print copies due to parents' preferences. Textbooks. Textbook sales volume are expected to increase with the growing percentage being sold as e-books. At the same time, publisher also bundling textbooks with a variety of online learning resources to differentiate their offerings. To differentiate, the online learning resources on which include smart books where pop-up explanations are available. Students' exercises and quizzes are costly to produce and must be continuously updated. Barriers to entry are high for textbooks due to the large upfront investment required, such as operating of online learning resources. Okay, so that's the industry, right? So from here you can draw only any risk related to the business.
Okay.
What will be the online learning, the high upfront cost you can draw here, and the other thing is that what else? The profit margin are low, 10%, dropping down on the ebooks. So let's see the operations. Has 3 divisions, each operating in one publishing industry major segment. Children's books. This division is profitable because it has well-known authors' work. It probably publishes. Primarily publishes book for early readers, as well as board books for very young children. Textbooks in 2021. This division experienced a higher proportion of ebook sales compared to the printed textbooks. Some of this company textbooks do not include online learning resources, and only those with the online have remained competitive to the prices and sales volume. So we have the problem with the online learning resources. Audit non-fiction, adult non-fiction. This division produces only Canadian authors' books, including large coffee table books with photographs. Although certain products remain profitable, profits in this division have been declining. So we have in both cases, textbooks and audit, profit declining. At the same time, we have a person who wants to get out. So he's going to do everything to increase the profits. Cost structure in the sales. This company pays the author royalty ranging from 10 to 15% of the book revenue. Company has its own sales and marketing staff. Sales representative are dedicated to specific customers, and I paid a seller plus 5% commission on sales. So from here, what you can draw? You can draw more users of the financial statements. Make sense?
Makes sense.
Right? Because those authors, they're based on the book revenue.
They want to see how much you're making.
Yes.
The
So
company, if it's profitable, to
exactly.
bring their books.
Right. Also the sales representative. They also want to see the sales because they're based on the commission sales.
Mm-hmm.
So now we have two other users here on financial statements. Has some titles representing about 45% of sales that are widely used and for which there is a little competition, ensuring stable sales year over year. Which is not bad, 45% on those ones. That's good. So those are the financial statements. Anything scary. Textbook revenue going down. We will expect it. Adults going down. Children are okay. Production and royalty cost. Those are relatively the same. Amortization, obviously pre-production cost going to go down year after year. And again going down. Gross profit, we have our gross profit, which is declining. Operating expenses going a little bit up. The only one is growing up is general administrative expenses. Everything else stays the same. Operating income now is dramatically down with $4,000, almost 4,000. Right, increase in the cost and operating expenses and the reduction in the gross profit. Those two together give you that net income. What's that? Comprehend operating income. Then we have interest income, interest expenses, income taxes. So total net income is 4,000 compared to 7,000, $3,000 going down. Okay. Most $3,000, obviously, 4,000 here, which is 1,000 on the income taxes. Everything relative the same. We have the interest expense on Jefferson bonds, which we didn't have last year, which is expected. So that's that one. Assets, cash equivalent, that goes up. Accounts receivables goes up too. Investment in bonds. We have this investment in bonds. That's new thing, right? That's something new. We have investment. Increase in property, plant, and equipment. Accounts payable steady. Accrue liability, okay. Everything else looks fine. Bonds payable, that's the bonds payable that we have. Loan going down with what is that? With the current portion of the loan, so there's nothing scary here on the loan. Deferred tax liability, since we're using the International Financial Reporting Standards. Retained earnings, okay, increase. Okay, we're fine here. I don't see anything. So let's see what's budget email from this person. Budget for the audit non-function division was based on the early operation. That's the budget. That's for managerial accounting, right? Only managerial accounting doing the budget. So the fixed costs are relevant to those books, which additional, the fixed costs included other production costs, which are fixed production elements. So it's 400 after the budget. What kind of budget is this? We finished the budget non-function based on the normal operating capacity. So here you have to look, is there any common cost for the company which are not traceable costs to this division? That's the only thing that you have to look for, right?
So when we're saying, is it something that doesn't
belong here?
the department?
Yes. Yes,
Okay.
on the extract budget for division for like this particular division, when you're doing the segment reporting, make sure that there's only traceable costs here related to that division, not any common costs. That's the general rule here. And if you have to adjust those ones, just revise the budget. That's the one. Now here we have a requirement from Jonathan. We sell that through the sales, right? Actual standard, actual selling price, standard selling price, actual variable cost per unit, standard variable cost per unit. So you can find here the variances, right?
Right. Yeah.
Right, sales variance and variable cost variance. You have all those on the three books box set and the single books. At the beginning, because Maria research indicates increase, but we're gonna do with those as variance reporting and analysis on the variance reporting. Let's do it when we start doing managerial accounting. Let's not spend time now. Let's focus on audit on it only. Please, we have to do sales price variance and sales volume variance. Each product, the strategy of the effective increasing. Okay, so we clearly know what we have to do here. The
Yeah.
question is, do you know how to do it? But we're gonna come to this when the time comes. So the next, I needed to use system setting the selling price for this one. So for the sell new book, audit non-function, forget language. So here you have two options from the absorption cost in pricing. So we select the best of two methods to price the book, a full absorption cost in pricing or demand-based pricing. Expected sale volume, different price points. So you have to choose one of those. Please also, please calculate the target price using the two methods and recommend selling price of the book. Please also quantitative, qualitative analysis. That's on managerial accounting. That's a standard thing. There's nothing scary here. We anticipated high demand on this book. However, given the price cost, okay. Now we're going to the inventory information. Doris provided with the excerpt of the finished goods inventory listing on December 31st. So what we have here, we have inventory item, inventory handle book 10,000, cost per book, inventory value. Low ethic 15,000, 15,000 book 2560. That's the inventory value. Doris also provided a list of the return book that were in transit from the customers at December 31st. Take ownership of the return books when the books leave the customer's premises. Okay, so you understand this, right?
Yeah, I understand it.
So the fact, so the question is, are those books recorded in our inventory?
Mhm.
Since when they leave the warehouse, they're ours, right? All the books in transit were recorded inventory at the end, so we don't have problem with that.
Mhm.
So now what we have here, introductory physics, book warehouse December 0, but quantity on transit 3,200. Cost per book that much, inventory value that much. And this guys here, biochemistry, book warehouse 0, but in transit we have almost 5,000. So we have 205,000 inventory in transit on top of that. Now this received 2,000 were damaged and not sellable. So out of this one, receive not one. Where is the not? Not here, not one. So these guys, 2,000 are damaged and not sellable. So we have to adjust probably the inventory here, right?
Yeah. So now, in this scenario, it's about whether they've recorded that returning inventory, and they've taken into account the w- the new value of the inventory, whether it was recorded the lowest of cost or NRV, right?
Yes,
In
yes.
this case, we have to write off some.
We
So we want
directly,
to,
yes. Yeah, we directly have to write out the 2,000.
yeah,
Once we have the condition they're not sellable,
Mhm.
We have to reduce the inventory with the 2,000 units right there. No questions about it. That will be like what will be that? Spoilage or whatever. Lost in damage. And those are all in good condition, so on the note 2 we are fine. That's inventory is on hand. That should not be a problem. Anything else here? We only have the inventory and cost per book, right? We don't have any sales value and anything like that at this point. Only for this one we have this damage. Let's move to the next one. Maria, marketing. The price of the following book were amended to reflect the change in demand. Introductory of Ecology, $55. Do we have here introductory of Ecology? So cost of the book is 57, sales price 55. Right there. And we have note 1. A contract commits the customer to purchase 20,000 books at price of 75 each during the 9-month period ending April 2022. By December 31, we had sold and shipped 13,000 units under this contract. So whatever we're doing with this, 7,000 have to be excluded. Make sense?
Makes sense.
Because we have 10,000. So the 7,000 has to be excluded from our calculation because they're already at price 75, which is above the sales price at December 55. And for the impairment only for the 3,000 units from 57.20 to 55. In February, so let's go into Introduction to Physics 2530. Introduction Physics cost is 1578. I believe we are fine here, right? Cost is lower than sales price, so we're fine. And biochemistry, we have 2816. Biochemistry is also okay, 3290. We are fine with this. But we have note 2. On February 22nd, the 5th edition will be released by the 6th edition. We usually stop selling the old edition during the 2 months prior to the new edition being released. In February. So basically all those 4,700 units are not sellable. Is that what they're telling us? Sounds like this way to me. In February 2022, the 5th edition will be released by 6th edition. We usually
stop selling
old edition during the 2 months prior to the new edition. So December 31st, are those sellable?
No, I don't think so.
No. So the entire inventory 154, gone.
Gone.
We estimated that our available cost to ship the textbooks to retailers will average 1.5 per book. Since we're not selling those, that cost will not be incurred, right?
Mm-hmm.
And that will be part of the additional cost that we have to add in order to come up with to net realizable, right? So how much we're selling minus how much we're paying. So here will be 55 minus 1.5. 53.50 versus what was that? 57.20. That will be then our net realizable. Okay, so that we've done. And now with the contract with the Kingsley University under the term defer, and that differ from the typical contracts, except for the contract, Kingston agreed to purchase 3,000 units of Architecture 101 First Edition, a total price of $360 per unit. Each unit consists of a printed textbooks in online learning resources. The books runs for 8 months, and the OLR will be accessible to the students for the entire subscription period. To complete the course, students must use the textbook to complete the assignments on the online resources. Kingston prohibit from selling the textbooks or online learning resources separately. Kingston agreed to pay in full within 40 days of the receipt of the textbook and commit to ship the books on August 15, 2021. We shipped on August 12. Kingston signed the receipt for the receipt for the textbook on August 14. Revenue of 360 was recognized. Full payment was received on September 16. Okay, paid sales commission 50%, 5% on this contract, and incurred travel cost to present the proposal to Kingston. There is a sufficient profit from this contract to cover this cost, which have been recognized over the sales expenses. Awesome, but we have a problem here, right? Because the contract from September 1st to April 30th. How much you received and how much you recorded for revenue, that's irrelevant. We have to follow the standards and prorate the revenue over the term of the contract, which is 8 months, right? That's easy fix. Here you can see the financial reporting issue right away. So we have two financial reporting issues as long as I see. We have the impairment of those books, write-off of the damaged books. What else? Write-off of those books which cannot be resell. And we have the problem with the revenue recognition, as always on the CFE exam. Right? Let's put that note. Always revenue recognition comes on the CFE exam. That's another proof of that. And this case is recognized revenue before the contract expires. Again, with all the expenses which are related to the contract. Now, the only thing is here will be the sales commission. Can we recognize that cost? Since once the book is sold, I don't see any agreement here that will say that they can return the book. That will be the only tricky part here, or the 5%. The 4,800, since those are related to the contract, we have to prorate that expense over the contract, I believe. But the 5% commission, sales commissions, once it's sold, right? That will be something. Do we have to prorate it over the contract or not? So let's go now to the assurance stuff. August 1st, enter into the joint arrangement with this company. Now, once you see here assurance additional information in joint arrangements, discuss on the assurance, obviously you have to discuss the joint arrangements here. Make sense?
Makes sense.
Even though if we go back to our requirements, which were here, right here, seems like this joint arrangements, we have to discuss the accounting treatments with the joint.
Yeah, we do. Yeah.
Right? Which doesn't make sense because that's a financial reporting. Right?
Isn't it the same thing? But they're saying discuss the accounting treatment, it's just FR.
It's a FR, yes. But since it's given under the section of the audit,
now it's under the section of the audit, not
right? No,
not with all the other.
right.
It's for us only.
Right. It's for
So it's for the assurance role only.
Right.
So when things are presented that way, is there like a special case with that one item?
Once the information is given on the assurance, you're discussing this part of the assurance problems, right? No questions about it. There's nothing we can do, right?
Okay, yeah.
Right. So I know we're gonna discuss that. What was that? Stop. Let's go back to the requirements and figure out now what we have to discuss where. In here. So we're gonna ask for the budget, cost, and price. That's managerial. Then we have to discuss accounting treatment for inventory. Inventory data valuation and Kingston University contract, which is the revenue, and for the joint arrangements. But the joint arrangements, which is even accounting treatment to the joint arrangement, that for us is part of the audit, right? That's the thing that's I won't count it. Once I read in the requirement, I won't count joint arrangements as part of the audit. Clearly,
Okay.
but it's part of the, since it's part of the assurance requirements here first, and all the information about the joint arrangements are given only and only in assurance, then obviously we have to discuss it under the assurance, which is fine. So now let's see how they, what kind of information they're giving for those one and how that is treated. On August 1st, 2021, entering joint arrangement with this company, the company that specializes creating mobile application. Each company invests 500 in the return of 50% of the shares of the Smart Kids, a newly created legal entity. So they both creating new legal entity. Everybody invests the same percent, 50%, 500,000. This company, so the CPH, our company will provide its experience for the design and printing the on the books, where the other company will provide the mobile application expertise. Smart Kids, the new company, will produce and sell new line of the interactive book featuring traditional fairy tales such as Three Little Pigs and Cinderella, I guess. When a mobile device is held over the printed page, in the words on the pages are read out loud. The application will animate the printed characters on the screen. Okay, a contractual agreement specified the rights and responsibility for each party was signed by the both companies. It contains the following items. So let's see what's on the contract. The new company requires, if the new company requires additional funds, both parties will contribute equally to it by purchasing additional common shares. Second, all assets purchased and liability incurred by the new company will be approved by both companies, but will belong to the new company. New company will be responsible for payroll and any other administrative functions. At the end of 2025, no sales have been made by the new company, although there were many interested parties. Doris recorded 500,000 as a production expense for the year. So now what's happening? So if look at how badly they give you the information in order you to make a mistake, because you can easily read the whole paragraph here without even notice the last sentence. You can easily do that, correct? But the last sentence tells you, as you read the whole paragraph, the last sentence has nothing to do with the first sentence. How the door is recorded has nothing to do with the sales and are there many parties interested. Those are two different topics. So but they put it this way in order you to miss it. So she recorded as expense for the year. Is this expense? Obviously, it's not.
It's not an expense, it's a cost incurred to
It's
realize the investment.
So no, it's not. It's investment, directly investment. I would treat it directly as an investment. So now we're going to the point. What kind of which reporting we should use for investments? Is it going to be cost method or are we going to be equity method? Right. Those are the two options. We don't have anything else. Cost method means that to use the fair market value, but that will be for investments. We don't have a significant influence. The question is here, do we have significant influence? Most likely we do. Now, do we have a control? We don't, because we don't know more than 50%. Now, once we go to that direction, no significant influence, consolidation. Consolidation is for the parent subsidiary. Now we're going to something else. Is this a joint arrangement?
Yes.
Can we treat it as a joint venture? It is joint. That's the key. That will be the key here. And the other thing is as of December 31st, plus following balances: total assets, total liability, total equity. In addition, this company incurred loss of $200,000 in 2021. Now, how the loss was recorded, we have no idea at this point. Right? It wasn't even recorded, we don't know. But since this is like a we investors here, whatever the loss is, that's become our loss, right?
Yeah.
Not the same percentage that we owe. So let's see how they're treating this one. Let's go one by one and flip back and forth with the what will be that? That will be with the solution. So we can see directly, instead of reading, keep going, rather than staying with the problem, solution. That will be the better way, right?
Mm-hmm.
Okay.
So when it comes
Yes.
to joint arrangement still has you need to determine control, and then you need to determine equity.
So let's see how exactly it's solved. Let's go, because the solving here is very interesting and very like a very traditional way of solving financial reporting issues, which I want you to see it, and I want you to actually like memorize it, no, but understand it, so you can start applying this approach when you're solving the problems.
Okay.
Right? That will be the key here. You to see exactly the flow of the information and how the thing is. So this is the main. This is the main. We're not going to spend time here. This is another main. What was that? This one is the depth and breadth. That was the candidates we discussed. Consider selection of the pricing method. Okay, pricing method not here. So here on the discuss inventory adjustment. So let's quickly on the inventory, what they do. Receive 2,000 damage, not resellable. Revised quantity, okay, 1,200. In good condition, okay. Estimating the net book value. So this will be 5720, introduction 75. So they're comparing here, come up with the write down on the inventory.
Mm-hmm.
Right, and then we come up with this accounting treatment for this contract. 5 elements of the contract. That's purely financial reporting issues. You're chasing 1, 2, 3, 4, 5. Make sense?
Makes sense.
Every time when you see revenue recognition, there's nothing to wonder here. Get the 5 things directly from the Direction of Financial Reporting, revenue with the contracts with customers. Boom, and start comment on those things. Which one is here? Which one is there? If one is not met, forget about it. Literally. So that's the adjustment that has to be made. Let's go to our assignment. Now, first thing, Doris recorded 500 related to Smart Kids as a product expenses. Right? Watch this sentence. Watch this sentence. That's on page 104. And let's go back to 104. And let's go back to page 60. Doris recorded as a production expense for the year.
Expense for the year.
So directly what's on the case, that's your starting point. Right? Copy and paste, literally, as a production expense. The only thing that they added is Smart Kids. So that's how they use the case facts. They're literally writing everything on the case. That's not plagiarism. Okay? If you just rewrite the case, you're gonna get NC everywhere. You might even, some of them, they can give you RC based on the marker.
Okay.
So keep that in mind. Case facts are important. I want you to use the case facts, please. So, guidance of these arrangements, we have to go with the international joint arrangements. First, we have to determine first we need to determine if the joint arrangements met the definition of the joint arrangements, right? That's the first thing. Is this actually joint arrangements? And we start. Joint arrangement has the following characteristics. Party boundable contractual agreement. Contractual agreement gives the two or more of the parties joint control of the arrangements. So now you applying the case facts. As there's a contractual agreement outlining specific rights and responsibility to each party, this criteria is met. Arrangement also provide joint control, as all the assets purchased and liability included must be approved by both. So all the decisions related to the company will be made jointly. Now, can we find this one on here? Contractual agreement is responsible. Each party was assigned right here, right? You're not making anything here. You're just rewriting the case facts, and you say this criteria is met. Boom. All assets and liability incurred by member will prove both and belong to but you can even stop here.
Okay.
Right? And then we're going to 104, and you see that here. The agreements also provide the joint control as a special purchase. So purchase and liability incurred by must be approved by this. Again, case facts. So decision related to the company have been made jointly. Next.
Okay.
Now, the only thing that they not saying here, part B is also met. The only thing that they're missing here on this paragraph is A is met, criteria A is met. They're not saying criteria B is met, as you can see. Now we're moving to the next one. Next, entity shall determine the type of joint arrangement which is involved. Which are the two options? Joint operations, joint venture. Right? What is the joint operation? Right? So there's one option. If you want to chase only RC, you can go directly. Entity shall determine what type of arrangement. Two options are joint operation. Second option, joint venture. Now, if you want to go to C++, now you have to explain what or give them more idea what the joint arrangement operation is and what the joint venture actually is, right? So the joint operation is the joint arrangements where the parties have joint control of the arrangement, have the rights to the assets and obligation to the liability relating to those parties are called joint operators. Right? So they only have the rights to the assets and obligation. Where the joint venture is the joint arrangements where the parties have joint control of the arrangements have rights to the net asset of the arrangements.
Assets.
Right? This is the key here. One have assets and obligation. Here you have rights to the net asset of the arrangements. Those parties are called joint venture. And then we go, international provides a flow chart of the factors considered determine whether joint arrangements, joint operation or joint venture, where the arrangements are structured through the separate vehicles, which in case created a newly legal entity for these joint arrangements. The first question to consider is, does the legal form of the separate vehicle gives the party the rights to the assets and obligation the liability relating to the arrangement? In this case, all the assets purchase liability incurred by Sitka will belong to Sitka. Therefore, those two companies do not have rights to the assets and liability, so look at this. We're not trying to prove that it's joint venture. With this sentence, you're proving that it's not joint operations. With this paragraph here, right? With the first paragraph, you clearly says, okay, they don't have rights for the assets and liability because those belong to the new entity. But to the shares of the company, which is to the net assets. So you eliminate the joint operation, go to the joint. Next question to consider is, do the item of the contract arrangement specify that the parties have the rights of the assets and obligation of the liability relating to arrangements? So the contractual agreement itself does not appear to have any terms which provide us both companies having rights to the assets and liability generated. Therefore, that's not the case. So joint operation here automatically disappear. Finally, we need to consider how the party design arrangements so that it's actively primarily aimed to provide the parties with the output and blah, blah, blah. SmartKids will produce the line of new books, which will be self itself. So those outputs not belong either company. In addition, it's not expected that SmartKids will depend on the continuous basis of those companies to settle liabilities. And it will eventually generate sales to settle its own liability. Therefore, that's not the case. So it's not, we're proving here that it's not joint operation. We're not proving that it's joint venture. We're going the opposite way. So indirectly, we're saying that that's a joint venture. Given those analyses above, we consider arrangement to be joint venture. So if it's a joint venture, what do we have to do? And the joint venture shall recognize the interest of the joint venture as an investment. So this is the key here, as an investment, and shall account for that investment using the equity method in accordance with the ISA, International Accounting Standard 28. And unless the entity is exempt from applying equity method as a specific in that standard. So now, if you want the C+, chase that exemption. Make sense?
Makes sense.
If you want only C, you can stop here. This is the exemption. Now they're chasing the exemption. Is this exemption actually exists? And they can come up with that does not apply for this, where the creation B met the private and therefore not traded for public market and creation and all those things. Therefore, should recognize the interest using the equity method. So using the equity method, so now we have to explain what's the equity method. Do you see this is a real actually textbook. First, is this meet the definition joint arrangement? Yes, it does. Because if it doesn't meet the definition joint arrangement, we're not going to go after the joint operation, joint venture. Right? If it's yes, first one, yes, then what's the option here? Options are joint venture, joint arrangements. Joint operation, joint venture, right? With seeing which one is what, then under that, once we establish, okay, this is a joint venture, how we should report it. We come up with how we report it. Is there any exemptions? Yes, there are exemptions. Is this company actually meet the exemptions? No, they're not. For that reason, we have to use the equity method. Now, if we have to use the equity method, what is the equity method? And now we're going to the completely different standard. Right? Now we not longer if any of those standards are related to the joint venture. Not on the accounting standards, International Financial Reporting Standard 11, not in accounting standard 28. We're going down to the accounting standard number 1, presentation of financial statements, where under the equity method, on the initial recognition investment in the associate or a joint venture, it recognizes its cost. And the carrying amount is increased or decreased to the revenue investor shares of the profit and loss of the investee after the date of acquisition. And blah, 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 blah. Therefore, now the conclusion. Therefore, amount to be recognized should be initial investment, 500, less than share of the net loss. So if I were you, I would do this. Therefore, the original amount of investment should be the initial should not be it should not be recorded as a expense
Mhm.
should be recorded as an investment. Furthermore, the loss, net loss of the kids of the new entity for the 2021 should be used to adjust the investment in the company with the proportion to the share of the company to the joint venture, which is 50%. So out of $200,000, $100,000 belongs to the, and the adjustment required will be this and this and this. Boom, 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 done. Now, do we have to do impact analysis here? Because as you can see, we're doing the analysis, we're coming with the conclusion, we provide recommendation with the journal entry, but there is no impact analysis. Can you see it?
Yeah.
So
Yes.
that
Why are we
means
not doing an impact analysis?
I'm not sure, but you can even put one sentence here. This adjustment, we're going to increase the revenue,
Mhm.
which will impact the parties which are interested in higher revenue. Right there. And that will be your impact analysis. You don't have to even stop here. You don't have to go any further. So the C here, the C, we're gonna come from getting the joint arrangements, joint venture, and getting the journal entry. C plus gonna come from the part that you going over the exemption and identify, is this exempt actually exist? And the equity method, even if you explain the equity method with your own words, is going to work for the C. Okay, so let's go back to the requirements, which will be probably page 61 now. Let's see what's happening on page 61. Again, this is a clear definition, textbook of the financial reporting issue, how it's solved.
Mhm.
So the next one, we're done with no, we're not done. Hold on a second. We don't need this. We have other things to deal with. Once we're done with this, with the joint arrangement, let's see our requirements. Where we going now? Our requirements.
Without going to procedures.
Now we're going to the audit plan. We have to prepare
No.
audit plan. First, we have to do the
Oh,
audit plan for December 31st, 2021 year.
oh, we don't have procedures for each financial report.
No. Later on, we're going to have recommend audit procedure for the accounting issues. Later on, right? First, we have to do the audit plan, and then we're going to go to the procedures. Right? So let's go back to our case. That's our solution here. So this one is not relevant right now. Let's go back to page 104. So now we're going to the audit plan. Audit plan, you know how it is. We start going through the materiality. Actually, discuss materiality audit approach. No, first, sorry. First, we on the audit plan, we're going first with the risk. Clearly for the risk. Important first step to the planning of the December audit is to assess the risk of material misstatement of the financial statements level. We have identified the following risk: material misstatement, the financial statement level. Brand plans to sell. Okay. So you see, the brand comes right here as a problem. Because he wants higher price. Second one, Suzanne, controller, left the company. We don't know what's happening here. Yes, we have the effective internal control, ability to day-to-day operation. What is that? Although Suzanne departure caused accounting departments, you will take an action to correctly. Let's go back to the case facts, because at this point we don't know about this, right? Let's go to page 61. Is there anything says here about this new person? Is this additional information assurance? Yes, that's an additional information assurance.
So that is for the sales cycle risk
Yeah,
because we have to produce
yeah,
how do you call
yeah,
it?
this is, what's that? Additional information for fiscal. Informational technology IT department delayed the planned upgrade to the accounting software early to 2022. For the last week of 2022, the program would freeze up unexpectedly, but reboot always resolved the issue. However, Doris wondered whether the accounting subledgers were impacted of any of those incidents. During the year, hired Connor Smith, Director of Data Analytics. Connor is responsible for the weekly dashboard provided by the management. This team is performed extensive testing on the dashboard to ensure the data integrity. Audit junior attended count. So the audit junior attended in December 31st. Inventory count, the CPA was satisfied with the count procedure and accuracy. This yeah, every time when I see something like this, you know what it reminds me? It reminds me of the time when we were audited, and when the audit team comes to the company.
And they're asking for to see your stuff.
No, they want to see the inventory and where they count the inventory, right? That's what they do. The only
Yeah,
thing that the audit team doesn't know is what we're doing before they took off. Right? That's the
yeah.
only thing that the audit team doesn't know. And they don't know that as soon as they step on the front gate, the security is specifically advised not to let them go before they call for permission from the accounting department or first CFO. And the only thing that the security tells the CFO is how many people, what's their age, how many males, how many females.
Oh, really?
Absolutely.
Interesting.
And then from our people, we already know they're gonna come. We already prepared. With the girls, going the specific guys which are already prepared what to do. With the guys, going specific girls which are dressed appropriately and to go with them. That audit team doesn't know. And guess what? What the guys auditors counting? Do they count the inventory or counting the how high is the girl skirt?
Interesting.
And that's the standard procedure, my dear.
I had no idea. And I used to do inventory counts. I just used to go.
Yeah, used to
Right.
go, but if I'm doing something, I'm gonna send the most attractive guy in the company by knowing who you are, because the security already told me. And trust me, he's gonna do everything, and you're gonna find exactly what I want you to find.
Oh my God. Interesting.
Yep,
Interesting.
yep. Preparation. It's all preparation. Do your homework. That's why I want you to break these cases, these exams back at piece by piece, and then put all the pieces together on the final exam.
Okay. Yeah.
Right? That's the whole point. You to see everything from different angles, how you can approach. Every time when you see a sentence, to know what to do with that sentence. Every time when you see additional information, where can I use this? How can I use it? Where to do it? How to do it? Obviously, because the requirements are so many, it's easy you to at some point to lose track of it or to lose concentration. That's no questions about it. But at least
Mhm.
most essential part, you'll be able to get it. Trust me, even professional Right now, the CPA who take this exam, he never gonna pass.
Yeah.
He never gonna pass because he's not prepared for this. When he see case like this, he doesn't know what to do. It's a special skills. You have to have these special skills to solve this type of problems. This is the same thing like a person who drive the car going to the road test. Do you know how many examples you have people who can drive the car perfectly? They cannot pass the road test. Does that mean that they cannot drive the car? No,
Yeah.
it doesn't mean anything. It means that they cannot pass the road test. That's all.
Interesting. That's very true.
Yeah.
That is very true. I've seen a lot of people who can drive, but they just can't pass the road test for some
No.
reason.
Yeah. Does that mean that they cannot drive the car? No. They can perfectly drive the car. They just cannot pass the road test. So the same thing is here. So let's go in September. This company purchased land. Okay, that's the purchase land of $1 million and hire company that started construction in additional warehouse. As of December 31st, the construction was completed and the $2 million of construction costs were incurred. Information about the sales cycle, monthly sales percentage, blah, blah, additional DAFO accounts calculated 3% gross account receivable, consistent with the prior. Canadian economy is struggling to recover for the recent recession, has been increasing accounting outstanding for longer than 60 days, plus related write-offs, would not normally have the accounts over 90 days category. The entire balance of this category related to the accounts on one company only. Estimated uncollectible accounting rates for 3 to 5 gross accounts receivables. Watch this. Latest customer updates. Boom. File from bankruptcy, which is the entire balance of this category related for We Love Books over 90s, and that's $840,000 over 90s are related to the company we just filed for the bankruptcy. Awesome, right? That's going to increase the risk. So internal audit department, Louis internal audit loaned Louis Swanson, CPA, to the accounting department starting December 15, 2021. Despite this, the accounting department is still understaffed, and Louis has struggled to review the staff work on the timely manner. Per the internal audit charter, responsibility included confirming the independence of the internal audit to the audit committee at least annually, submitting annual risk-based internal audit plan for approval, annual risk-based audit plan for approval, ensuring that the planned engagement was executed, work programs and testing are documented and results are communicated, and following up the recommendations and reports of the audit committee any corrective measures not implemented. Audit managers, internal audit, are required to have both CPA designation, either CA or Certified Information System Auditors designation, plus the minimum 2 years internal audit experience. Each auditor is required to have a commerce degree and to complete the CICS program within 2 years of the start date. From January to December 15, internal audit was fully staffed. The audit manager are responsible for planning internal audit, which are then performed by the auditors. Audit managers review the work performed by the auditors and draft the audit report. Belvin also perform a review of any audit files and audit reports prior to issuance. Was the Belleville internal audit charter? Belvin responsible. Okay. Internal audit performed numerous internal audits during the year of ended December 31st, including audit sales, generative cost, payroll, sales, marketing costs. Some audit reports issued included findings. For example, internal audit department that although the cost incurred was reasonable, some sales representative had stayed the inappropriate hotels. However, no material weaknesses or significant deficiency of internal control were reported. By December 31st, all recommendations made to internal audit were being implemented. And children's book, here is the children's book area. Internal audit issue a report regarding children's book internal, noting that material weaknesses significant. There's nothing on material weaknesses. On September 15, sales management responsible to the children's book division left. Brian was able to recruit Yolanda Valles to replace him. She started on November 1st. When she started, reviewed the monthly budget to actual sales report on the division for 2020. Because she noted no significant issue, the sales representative have been authorized since November 20 to set up new customers and determine their credit limits.
The limit.
Right. So now we have everything on their level. Upgrades were made to the same system in November, where certain information is now pre-populated in the system. For example, when sales representative enter in order in the system automatically populates certain fields such as shipping address, telephone numbers, and email addresses, and once the customer is selected. In addition, when the sales representative select the item to be ordered from the drop-down menu, the prices related to that item is also automatically populated. If any pre-populated are incorrect, sales representative change the information in the field before submitting the order to the system. Can he do that? And should he do that? Because that gives him a power to change whatever he wants. Discounts were rarely authorized before Yolanda joined, but she understands how important it is to give the sales representative flexibility. Since Yolanda joined, sales representative was therefore been authorized offer of 10% volume discount to a customer of the children's book this division if they believe the customer are purchasing more than usual. Okay, belief is one thing, ordering more than 10% is different things, right? Volume discounts of more than 10% must be approved by Yolanda. When the customers are delinquent in paying their invoices, the accounts receivable department asks the sales representative to follow up. If the sales representative thinks that the collection is unlikely, then let the accounting representative receivable department know that an amount is written off. Awesome. That's awesome, right? When Yolanda joined, she decided all the sales representatives should have tablets to stay connected. The tablets arrive early December when the IT indicates that it will require 5 business days to set the tablets the tablets up with the virtual private network access, encryption, and antivirus software. Wanda decided not to delay the issuance. She instructed the sales staff to return the tablets between Christmas and New Year so the IT could work on them. So that will be definitely problem with the security and problem with the information about the customers and all the discounts and everything, so they can do whatever they want. Let's see how it's going to affect our audit. Right, that's where we're going here. So Brian is one thing, Suzanne is the next thing. Now we're getting the Louis Stevenson. We bring it to the we're able to account day-to-day transactions, so also non-standard transactions. However, we are also aware that Louis has started to review the staff work on a timely manner. So that increased the risk. Even though, so Suzanne left, good, that's increased the risk. New person come, that kind of partially reduced the risk, but because he's not doing everything on timely manner, that's increased our risk. Revenue has been declining overall, and specifically on the textbook division audit non-function. This information, we have it in the very beginning, right? We don't have to look the financial statements here. And since we have that these people wants higher revenue, that will put the pressure on the performance. That's increasing the risk. Contract the Kingston has different contractual term for the previous sales contract. In our work to date reviews that accounting transactions were incorrect. So we're going with the contract, we identifying that, and we putting that one. That's increased the level. The next one is this children books division.
Yeah, the lack of controls there.
Right.
That
And note things that she did without giving too much power on the people. That's increased. IT delayed the plan to upgrade the software until the early 2022. That's another thing that increased the risk. As a mitigating factor for the financial statement risks, an internal audit has been formed, and this is the only thing that actually reducing the risk.
the
Right?
fact that an internal audit
Right.
exists. Yeah.
Yes.
Is this
Yeah.
a recurring engagement or it's a new?
No, that's happen. Sorry, is that an I don't know. That doesn't say.
Okay.
It doesn't say. It doesn't say that. For that reason, we're not addressing this as a area of reducing the risk familiarity with or being the second audit, so we know about the business.
Okay.
So technically, once you're assessing the risk, the natural conclusion should be risk is assessed high.
Yeah.
Right.
It's always
Now, regardless what kind of case you have, since it's a case, obviously you have to assess the risk of high.
Yeah.
Right. There's no way you to go on the case on the CFI exam and says, you know what, the risk is low.
Yeah.
Right. That would be ridiculous.
Yeah.
But we already know that. So for that reason, I want you to make this conclusion.
Always make sure it's high.
Right.
I think there's only one case I've seen it be medium. Only one.
Only one, yes. But general will be material misstatement should be assessed as high. And even if the medium you say is high, that's totally fine.
Yeah.
Okay, then we're going to the next thing on the audit plan, that will be materiality. Before we go to the materiality, we're going to go to the users. All the owners, which own the percentage. Then we have who is particularly interested, Brian. Why? Because he wants to share. Who the next one? The next one is the one who have the bonds and who is interested to come. The next one is our what will be that? Our sales reps, our what was those guys, the authors, right? Those are the one who are also interested in our financial statements. There's no banks, there's nothing like that in this case, which is kind of okay. So now we're going to the materiality. Listen, watch this. Always this standard is used. So basically, remember this one, put yourself a note. Once it comes to the materiality, Canadian accounting standard, Canadian audit standard 320 just has to be natural for you to mention that standard.
Okay.
Okay?
Yeah. I mainly mentioned for the definition of performance materiality.
Right. But again, CAS 320, that have to be on your work.
Okay.
Right?
Yeah.
And then get something from that standard and start working on the materiality. Now, the question here is, once you come up with what you're going to base your materiality, do you have to make adjustments before you come up with the materiality? That will be the key here. So,
Mhm.
but listen this. The whole thing is the audit planning, you're doing it before you even see the statements.
Yeah.
So is it possible you to anticipate all the write-off of the inventory, revenue premature and everything? Is it possible for you to recognize that one? Absolutely not. So,
Okay.
and we already saw a case when they come up with the initial materiality,
Mhm.
and after that they made the paragraph. Because of the following adjustments, we might have to reduce the materiality if we do that much.
Yeah.
Right? So that will be appropriate way for me, you to structure your answer. Base the materiality first on the financial reports.
Mhm.
And you can easily say, materiality is based on the financial reports presented by the company. Further adjustments may be needed based on the adjustments that we might have to do on the if we identify any financial reporting issues.
Okay.
And all right, finish your financial reporting, and once you see the adjustments, go back here. Now, the only thing that we adjusting here was in the audit was the joint arrangements.
Mhm.
That adjustment you can easily make it, right?
Mhm.
But once you finish your financial reporting issues later and you see the numbers, you can come back here to this part and you see now, based on the accounting issue that we identify and based on the adjustments, we have to
Yeah.
reduce our materiality by that much. Boom, done,
Oh, perfect. Yeah.
right? And
Yes.
that's how you're gonna stay away from the financial reporting until you saw the financial reporting, and then you come up with the performance materiality. On the
Okay.
performance materiality, once you say 60 to 75, even if you go to 75, totally fine. Risk is high. It's a first audit. You can easily justify it. I'm gonna go with the highest 70. Or you can stay with 70. 70 is the safe zone, right in the middle.
Okay.
But again, CAS 320 has to be there. In this case, 813 on the performance materiality, please. And then you're going to the audit approach. Audit approach will be the one that is going to be combined. It's going to be substantive audit approach. So in the beginning start as based on the users and based on the materiality, we have to decide which audit approach we should determine. Is it going to be combined or be substantive approach? And you can easily say the combined approach is this, substantive approach is this. So, and then start applying the case facts.
Mhm.
Start applying the case facts. See what increasing the risk. And based on that, identify your approach. In some area can be substantive, in some area can be combined. Right? It doesn't have to be one in every area. You can easily, for the accounting, so here you see for the IT issue, we're going to use substantive testing. For this thing, we're going to using the recommended to adopt combined approach. For the Suzanne resigning, we're going to do the substantive approach, maybe appropriate. Right? For different area, different approaches. Now we're going to the audit procedures for different things. Now, the audit procedures, does it have to reflect, does the audit procedure has to reflect the changes that we make to financial reports? No. We are in audit, we're not in financial reporting. Focus on the inventory. How are we going to come up with the numbers that they can come up? Regarding the inventory, first, get some understanding about the inventory. Calculation, obtain calculation of inventory cost, vouching specific items to supporting documentation that they actually purchase, a review of the selling price of those items, recalculate the lower of cost net realizable value. There is information suggestion that Sheldon return the books. That's physical books. So what we have to do, we have to go to those books to review the documentation to see if these actually books are resellable or destroyed, to find the proof that they're destroyed, and to find the write-off documents to recalculate the write-down of the inventory and to verify their accuracy. For the other one that's under the contract, should be reviewed to the relevant items such as the quantity of the books are purchased and the purchase price. Shipping documentations, those actually being shipped as of December 31st, are not still in our warehouse. So basically, those are standard audit procedure for inventory. Without doing any adjustments on the inventory yet. On the contract, same thing. Get understanding. Read the contract first. You understand the terms. Those are related to the books and everything. Then ensure that the content from the books are needed to completing the assignment from those people. Most significant on the contract occurrence is cutoff and accuracy. So go and chase those one. Amount of the cash. Make sure that the amount of cash is received. Cutoff of the revenue be recognized, so we need to recalculate the revenue from September 1st to December 31st. And then to the amount of the unearned revenue from January 1st to April 30th. On the contract cost, vouch the cost to ensure that the payroll records are there. Calculation of the amortization of the contract cost to ensure that this, all right? So you have at least 4 things you can easily identify here. Same thing with the joint arrangements. Review the supporting documents, examine the contracts, make sure the documents including the 80%, the 50%, the common shares are issued, the bank showed that the $500,000 are sent and the other company receive it. Make sure that the other company is actually registered. It's not like a fake company just for the purpose of manipulations. Go to the premises of the other company, find that the actual company exists, see what the research they're doing in the company, ensure that the amount recorded under the equity method is. Now we're going to the reporting. Make sure that it's accurate using the appropriate method. Recalculate the loss, see that actual loss exists. And those things. Now, warehouse in the land of the building. Now, the warehouse of the land of the building. Make sure that there is 3 million actually spent, because that's not like 100,000, 200,000. And again, go over the contract with the suppliers. Ensure that the building actually is there. Land exists and the building is there. Can you touch it? Can you feel it? Can you kick it? Ensure that it has the rights. Exactly, right? And the purchase agreement. Ensure that the amount has been accurately recorded. It's not like you can go even with the borrowing. If there's a borrowing cost, are the borrowing costs actually capitalized over the term of the contract and included in the cost of the building? You can be creative here. You can come up with something crazy that actually makes sense. You know where the tricky parts on the contracts are: borrowing cost, capitalization of the borrowing cost, any post building improvements or like a fixing on the building rather than improvements of the building. And make sure the right elements are put in the cost and capitalized of the building. You don't have much information here on the warehouse and the building, or warehouse, land, and building. We just have one sentence that says the building that was created and $3,000 are spent. $3 million are spent, right? Nothing else. But you have to come up with the ideas what you're going to do here. So we're done with this. Now we have to go and see what's happening with the sales cycle, audit procedure. Each of those risks and describe the additional information that is required. So the sales cycle, where we can find the sales cycle, let's go back to 62, I believe something there. Sales cycle. The trend in monthly sales as a percentage annual sales are generally consistent through the year with those other published houses. Allowance of doubtful account was calculated 3% of gross accounts receivable. Canada economic struggling to recover the recession and has been increased. So basically you have to draw something from every each of those. Would not normally have any accounts over 90 days regardless. This one established uncollectible accounts ranging from 3 to 5 gross accounts receivables.
So, yeah, there's so many procedures you can make with
Right.
all this information.
But
We know we can do.
stay with the bullet points. Drag something from every bullet point if you can. 1, 2, 3, 4, 5. Let's see if they come up with those 5. Can you remember though? 1, 2, 3, 4, 4. The first one is probably excluded. So existence of accuracy. So that will be what we're chasing here. Discuss the cycle, provided the audit procedure for each of those risks. So we have to identify the risk and then do that, and describe what any additional information required. The risk of the closed sales, recommend procedure, additional information required follow. Existence risk. Sales representatives are paid commission based on the sales, creating an incentive to overstate the increase in the fraud. This is the risk. Further, Brian has expressed his interest to sell the shares, increase him to manipulate financial statement to more profitable, increase the fraud risk related to sales. Now, what will be the procedures here? Should vouch samples. And procedure also provide evidence of accuracy of reported sales. Should also increase the size sample, isolated children book division beginning with Yolanda. Could send positive confirmation sample to the customer for the, so this is the improvement, right? Additional information that might be required. Because you recommend the audit procedures, now you have to add this additional information. Additional information will be that's why we're moving now on the some kind of future kind of thing. Could send positive confirmation to the sample of the customer for the early report not received on the timely manner. Should follow up with the customer. Should the customer still not respond to the confirmation, should agree to the sales amount supporting documentation. Monthly sale as a percentage of annual sales. Monthly sale. So do you have to label it this way? It's up to you, right? But I want you to identify some risks.
Okay.
Procedures
If you
on
get
the
the
risk.
risk, then
Yeah. So
there's no
now,
need to identify assertions in these ones, right?
right, you
In
just
this kind
discuss
of
it. Yeah, discuss it. You come up with something which is related to the case and extract from that particular part of the audit report that you're doing, right? The other thing, so now, as you can see here, procedures and additional information start to alternatively my voucher sales record subsequent to the year end supporting document. What else you can do, right? You're doing something. This is the things that you have to do. What else you can do is we're not talking about improving the situation. Additional information which is required to follow up. Subledger not matching financial statements. We already have, according to the statement financial position, reported gross accounts receivable, allowance for doubtful account this much, and net amount is that. According to a subledger, gross account total of that much. Therefore, the experience unexplained difference of 19,000. How did they see this? Is that true? On the subledger?
Yes, it is. Yes.
On the subledger total 8543 financial statements.
But nobody's gonna catch such a detail
No,
with the
no,
time you have.
no, no, no. But what you can do is, since we know this, since we already know this, if the issue is when they point you to one direction, then look, is there anything related to that direction? Make sense? Make yourself a note. If they're pointing to inventory, is there anything related to the inventory? Check the subledger with the financial statements. If they point you out in the direction of accounts receivables, check those one. If you have some subledger, that just quickly check it, because you're not going to have too much things of this. One or two issue will be on your requirements. Once you see something like that, go and check it, trace it back.
Even I can't see anything on your screen also.
No, did I stop sharing? What I'm sharing right now? I don't know what I'm sharing right now.
Because I'm
So
trying to see.
here, the financial statement. This one, the financial statement.
It's
8268.
not showing.
Screen doesn't
It
show.
just stopped. Yeah, I just stopped.
How about now?
Still same thing.
Still nothing? Let me refresh. Can you see now? Do you see anything on my screen or no? No?
No. Should I refresh mine?
That will be the other option. Try to refresh yours.
Yeah, it was a problem on my end.
So, yeah, once they point you one direction, try to follow up on that direction, right? That will be now.
Yeah.
So listen, what we're doing right now is not different than the audit procedure. We're making procedures how to approach the case and how to answer the case. So what we have to add to our procedure is when somebody start talking about the accounts receivables and give you something from the accounts receivables which have the total, compare that total with the financial statement, see if there's a difference. You can, right? That will be one additional procedures in our work. And next time we can apply this in the next case to see if that's going to work, or make it like a habit for the next case.
Okay.
Right?
Right.
Okay, so that will be that one. Let's go to the answer. Kingston contract journal arrangements. Now with this one, monthly, that's the subledger matching. So here, need to first discuss the differences with the manual. That's if we see the difference. If you don't see the difference, then comment on the, because that's the whole thing is about that difference. If you don't see that difference, what else you can comment on? Comment on the, I guess, on the DAFO accounts and those which are write-offs, the 3% write-offs, how you come up with those numbers, right? Here you can come with the amount allowance for DAFO account. Why that percentage? Why you not increasing the percentage since you having problem with the industry, right? The industry, you increasing the credit terms. You as you saw, based on the industry slowing down, we increasing the credit term with the 60 day over the 60 days. So that should reflect your allowance for DAFO accounts right away. And then we're going to the valuation of the accounts receivables. More than 60 related to the write-off and Western reporting Quebec region, biweekly management dashboard report. So that will be on that. What was that? 62, 63, this one. Monthly sales percentage. Try to use those charts as well, where the industry is compared to where you are. Once you see the industry and where you are, use those one.
Okay.
Right? And when you see something like this, that the credit score bad on the something, you try to use those one somehow.
Okay. Yeah.
I know it's too many things, but at least that's why we're doing, so we can understand when what you can use.
So you can definitely link some of these charts and diagrams to
Yes,
whatever you're.
yes, yes. If it's given, you have to use it. That's the thing. Otherwise, it's a purpose. It's not gonna given just because they want you to use it somewhere, somehow. The next one, where are we going with the next one? Next one is the candidate discuss appropriateness using the work of the internal audit department, suggesting procedure that were required in order to use their work. So the guidance provided using the work of internal auditor. Now we're going to this always going to be something. I mean, in this case, they not ask you for special reports, right?
Mm-hmm.
But they still want you to do this. They still want you to somebody's doing something. Can I use it? Or the last time was like they want to provide our audit report outside. Is that appropriate?
Okay. Yeah.
So now we have to find the guidance in the standards. Can we use that work? And then we have to ask the objectivity. Is this actually objective?
Okay.
And then we come with the first person responsible for confirming the independence audit committee. Those are case facts. And additionally,
Independence committee,
yeah,
as in, like, are they independent from whoever they're reporting?
yeah, you can say that because they're reporting to the board of directors and the shareholders,
Okay.
right? They, to some extent, they're independent, but how independent you can be when you're working inside the company, that's another thing. And since you're internal auditor, independent
Okay.
of internal audit committee. Additionally, Luis was loaned to the accounting department. Effectively, this so Luis could have direct operation responsible authority. This is the all the case facts, and how those case facts is gonna help you to those to be objectivity of the internal auditors. Chasing first the objectivity, then we go chasing level of competence. That's something new though. We never see this before. So to the extent of which internal auditor organization status and relevant policy procedures support the objectivity of the internal auditors, level of the competencies of the internal auditor function, and whether the internal audit function applies as a systematic or discipline approach, including the quality control. So basically, external auditors shall determine whether the work of the internal auditor function can be used to purpose of audit by evaluating the following: extent to which the internal auditor functions, organizational status, and relevant procedures and procedures support the objectivity. Is he actually objective in all those three areas? Then we call competence, what's his competence, and then whether the internal audit function applies to as a systematic discipline approach, including quality control. So that's why we're going with the objectivity, then level of the competence. Both they have level of competencies. Here we are satisfied with that. Now we're going with the systematic. Can you hear me? Hello?
It's breaking.
It's breaking. Let me refresh.
Was it?
Just a second.
Okay. Yeah. So it was the previous factor we were talking about.
We're talking about the level of competence, right?
Mm-hmm.
Level of competence is there. No questions about it.
Because
They both have
yeah,
that competence.
systematic and disciplined approach.
That
Is
will
that
be.
in the
Let's see
report?
what will be that. Belvin submits annual risk based on the internal audit plan and approval by the audit committee. Audit manager responsible for the planning internal audit, which is then performed by the auditors, and for reviewing the work performed by the auditors. In addition, audit managers draft the audit report. Finally, Bill will perform the final. So basically, you here following the process, okay? Audit files and audit reports prior to their issuance to the manager. Those procedures are suggesting systematic approach to auditing and commitment to quality. Okay. So technically what they're doing, they follow the whole process and asking, is this approach follow all the procedures? So that means, is this systematic? And if it's systematic, what's the level of the quality?
So if it's are we not, yeah, as in like are they submitting reports, getting feedback, recommending improvements that need to be made? Isn't that what it talks about?
Yes. Yes. So basically they follow the case facts here.
Is the audit report and the audit plan, right?
All right. Audit
Okay.
internal, but we are on the internal plan. So
Now,
we're chasing them on the internal level. Those two which are which we already established that they're objective, right? And we already established that they have the level of competence. Are they following the exact steps of the approach? Make sense?
my
Yes,
but
yes,
who isn't this, like, my thing with this part is that isn't are we submitting it to the to who we are reporting, or we're submitting it to management?
right.
Because in the previous case, they were talking about the previous case that we could not rely on that audit committee. But what they were just the solution was talking about how that internal auditor was supposed to be submitting things to management and having discussions with them, providing recommendations and feedback. So
Right.
I'm a bit confused with how come in this case they're saying we submitted to the audit committee, but in the previous case they said we submitted to management. Am I missing something?
I'm thinking, which will be more stronger, to submit it to the management or submit it to audit committee?
I mean,
Obviously, right?
audit committee.
Because management, we don't expect the management to have the right qualification to understand the audit plan and everything, right? Anything related to the audit, because they don't have that expertise. So for that reason, if you submit it to the management, probably that's not the appropriate thing to do. You should go with the more stronger, which is in this case will be the audit committee. Once you submit it to the audit committee, then we can establish that, hey, now you follow the procedures. That's more stronger, right? If you can say it that way. Ways to the management, we know the management don't have that expertise, they have not that knowledge.
Okay. But will the audit committee then communicate these findings to management?
Yes.
Okay.
Right.
Mm-hmm.
But they
Okay.
at least they have the expertise to approve or to monitor the what will be that all the work of the internal auditor. Make sure that they follow the procedures, the right procedures, in order to get the results that they are expected from them.
Okay.
So, and then once we do those one, we're going to the conclusion based on the above. Would be appropriate to use the work of internal audit in the performance of the audit. However, would be necessary to manage the perceived conflict due to the assistance Lewis has provided to the accounting department since December 20. This could be achieved by performing true review of the internal audit work performed and the related findings and recommendation during the last 2 weeks of 2020. When we audit the 2022 financial statement, if Luis continued to this new role as a extended period, it will be necessary to ensure that she is not oversee any internal audit performed in the accounting department for at least 1 year following her return of the internal audit. Interesting. That will be interesting. Use the work of the AI. Internal audit function. The external audit plans to use the work of the intellectual audit function. External audit. Are we going with the artificial intelligence here?
No, internal. No.
That's internal
I
audit,
thought
right?
so too. I thought so too when I saw that term.
Yeah, that's not right. Probably we're gonna use artificial intelligence at some point, but not too early. That's right. Not in 2022. So use the work of the. So is this the other requirement? First, we candidly discuss appropriateness of using internal audit department and suggested procedure will be required in order to use their work. So what will be the procedures to? Therefore, prior using the work, audit, sales, and general administrative costs, payroll, and sales marketing costs, I recommend the following: review internal audit charter to confirm responsibility, internal audit objectivity, review resume of Belvin audit manager auditors to ensure that they have the credential. Okay, so you start questioning everything. Even here you say, okay, they have it, now start questioning it. Check the evidence, has review the work, use the work the internal auditor to respect to sales, general administrative cost, and payroll and sales marketing to review the planning of the audit, nature, extent of the work. How they come up with this? All this auditor use the work internal auditor to external shall discuss function basis. The work function has been okay. How did they come up with all that specific area? Sales, general administrative expenses. Is that part of the requirements? It should be, right? Let's see if that's true. Walk through the yes. Here. Can you see it? Walkthrough of the sales, purchases, payroll cycle, or completed an internal field work. Perform use department established Bellevue. Here is the information about the Bellevue. It's directly in our case. And walk through the sales, purchases, payroll cycle. Internal control found to be operating on those area. Okay, that's how we come up with those particular places that they talk about in the solution. And now we're going to I believe that should be the last one, discuss any weaknesses internal control in the children's book division and provides a recommendation to address those ones. Weaknesses, sales are allowed to set up. Now we're going with only with the last exhibit that we have with the children's book, right? With the sales representative that they decide to choose, I would go first with the 10%. Who to give the 10%, who not to give the 10%, and then I'm gonna go with the uncollectible. Right? First, I'm going to question the volume discount that they're giving, based on what kind of what is the volume, how they decide on the volume, and then I'm going to go with the allowed to set up new customers and appropriate write-off on the uncollectible account. it's not appropriate to engage in those two tasks as a result of lack of segregation of duty, obviously. And writing off outstanding amount would be, that would not be outstanding amount balance, would be trigger investigation, obviously. Recommend Yolanda, but Yolanda should approve. That might not be appropriate here, suggestion, because she already give them that power. So providing Yolanda should approve, somebody has to make sure that Yolanda actually doing it. Make sense?
Makes sense.
Because she initially tell them not to do it, and now she to encourage them to do it. Yeah, we can say that, but then we have to audit committee to make sure that Yolanda actually follow the process. Sales representative allowed to determine the client's credit limits. Yes, that's inappropriate. The sales representative receive 5% commission. Sale will be incentive to grant the credit to the customer who are not credit worthy, or provide more credit to the customer. Yolanda should review those costs. Pre-populated information. Submission and all. There's a two issue with this. If the sales representative simply override the information in order to in the order, and pre-populated information is not fixed in the master customer database, increases the chances of error. So what we do, audit accounts receivable department should be responsible for making any changes of pre-populated information. Okay, and the next one is the volume. Now the volume discount. Now they're discussing the volume discount, the 10%, and the last weakness is the tablets. One thing, do you see one thing here? In the beginning, they start strong. Look at the discussions. And something here in the volume discount, they're getting smaller, right? Obviously, this is the last assessment opportunity. There's nothing else left, right? But that's a normal kind of, what can I say? That's a normal student answer. Start strong, get the first assessment opportunity on the row. It's like you can see those big discussions, and later they're getting smaller and smaller and smaller and smaller, and on the last assessment opportunity, the quality like a fading. That's a common thing. Now, once we know this, the question is, what can we do about it? Right? That's listen, it's not important how much we know. It's important how we using it when the same thing happen again, right? If there's no value that you know something if you don't use that information to improve what's going to happen next. So for that reason, I want you to learn from all these things that we're going to right now, and understand that there's something you can actually do. That's the whole purpose why we're going over this.
Okay.
Basically, what we're doing right now is, again, I can clearly say that we're doing audit. We're doing procedures, what to do on the exam. Once you see one or the other thing, that's what we're doing. Like no different than the audit procedures when you're doing audit.
Sounds good.
This case was interesting, right? Interesting, different industry, give you a different, more, a little bit idea about the different industry. I can say it's all right. It's all right. With a little twist, what was the biggest twist here? I don't see it. I don't see anything.
It's different from most cases, especially like I feel like they came very strong with MA. Like they dumped a lot of MA in there, and joint venture is not something you see a lot. So it was kind of tricky. Inventory was okay. revenue recognition was okay, except for the two costs about how to treat sales and other incremental costs. And then the internal auditor, they never usually ask for procedures. So
Right, that was interesting. Yes.
that was interesting because I've not seen uh that one. And then the sales cycle, because the sales cycle usually they would come and say from a strategy and governance, like it would be under MA, but it's kind of strategy and governance, and they say give us information like how to interpret the data. I kind of found it funny that they brought charts and said, okay, give us the risks from what information you're seeing. It was
Right.
different. That was
Yes.
very different.
Right.
Yeah. So
The other thing that I see different is yes, you're right with that internal audit and how we're relying on this one. That was interesting. The thing that surprised me, I don't see special reporting here. That's one thing that I didn't. That's kind of surprised me.
so special reporting.
Yeah.
Eh,
Usually they always throw something on the special reporting. Usually,
special reporting.
right?
Yeah, if special reporting usually doesn't come in day 2, it's gonna come in day 3, and day 3 is gonna
No,
be
no, no,
very
no, no,
short.
no. Listen. On special reporting, they cannot throw that one on for everybody. Because on the day 3, they testing about the breadth. People usually
I
they
see
don't.
special reporting.
Are you?
Okay, no, it wasn't a CFI case. Okay, now yes, you're right. It was not a CFI case. It was from Grevrog.
Right.
Yeah, I've not seen special
They
reporting
won't.
come.
Yeah, because
Yeah,
if
they wouldn't. That is
because they're gonna kill the students.
because they're going to be like, what is special?
Yeah,
But
exactly.
even
Yeah.
that's fair. But let me tell you what happened in our CFI. They brought acquisition for under tax.
Right.
Acquisition came in day 3, and a lot of tax students were like, they that doesn't make sense because acquisition is more of something that is tax in depth, like
True, but
things.
they don't expect the answers that you usually that they're providing in taxation. That's the thing
Okay.
that the students have to understand. And sorry, you're not student, you're a candidate. That's the one
Yes.
thing the candidate has to understand. You don't have
Mhm.
to be, you don't have to show them specific knowledge. You have to show them a breadth,
Fair.
right? That's the thing.
Yeah.
Yeah, they can show you whatever they want, but at the end of the day, do I have to show them that specific? No, you don't have to. How deep I have to go? Just touch the lightly and show them that you know what you're talking about. You are familiar with that particular topic, and you have knowledge of the minimally competent student or minimally competent CPA. That's what it is. Because at the end of the day, imagine this. You're going to the client and you are a practitioner. And the client comes to you and what you're going to tell the client? I'm sorry, I don't know anything about it. Can you say that to the client? Technically you can, but is
Mhm.
it going to be appropriate? Probably not. So do you have to come up with something, anything, just to make the client happy and get him as a client? Because in order somebody to become your client, he has to you have to make him feel that you have the level of expertise. Make sense? So the question is, can you come up with something just to show that, hey, I know about this. Maybe I don't know in depth, but I can satisfy your needs on this level. That's the whole thing. Don't forget that. Think about, approach the thing from this point of view, not from the point of view that you have to prepare everything. No. Nobody wants that from you. Okay?
Um. Yeah. Okay. I just feel like there's a lot to cover now.
No, it's not. It is seems like a lot to cover, but as you can see, it's getting a little bit more. How can I say? A little bit better with the coverage. For me, especially. For me, especially, if I feel that honestly speaking, more I'm going, I feel I can go and write this CFI.
Okay.
I'm kind of getting comfortable with this. Honestly speaking, I'm honest with you. We're covering it so far. We're covering enough kind of cases, and I feel that
Mhm.
I can actually do it without being in audit.
Mhm. Mm,
Start to feeling more confident about my understanding about audit now. I mean, audit is something that I only been audited. I never work in audit, right? And I have no interest to go in audit whatsoever. I have to be honest with you. Audit for me is something that it's wasting my talent and wasting my energy, wasting my time, wasting everything. Because I find it boring, audit like something that's it's boring. But at the same time, it's interesting because give you that level of control, level of understanding, level of seeing the things a different perspective, and at the same time making sure that those things actually exist. That's how we should look at the audit. So technically, do we need audit? I would say yes, we do. To what extent we need the audit? To the extent that we actually confirm that the things actually happen. Because if we
okay.
cannot confirm that the things actually happen, then we're in trouble.
That's fair.
That's why I always tell my students that I want to be like my sister. She's working for she's accountant, right? She's control of the government corporation back in
Mhm.
Bulgaria, and she's been there. She's working there for more than 20 something years. And that's very hard thing to do because having in mind that this is very, how can I say, very easily replaceable position. Why? Because first, it's a government. Every time when you change the government, you know what's happened. Everybody's gone. By default.
Yeah, that's
By,
true.
by default, it's all gone. Once the government changes, everybody is fired. She survived more than 5 or 6 governments. And nobody, once they go and see how she's doing her work, they saying, no, you staying. That's it.
Good.
Right? Which is amazing. But
Yeah.
why? Because she's doing everything by the books. She's literally doing everything by the books. She followed the procedures, exactly the same procedures with the audit and everything. When they go to the audit, the auditor finds the things that he's looking for. And they're there because that's how she's doing it.
Okay. Yeah.
Yeah.
No, sounds good. Um.
Okay.
Yeah. So, are we meeting tonight?
Can you?
I can. I have. I have a youth fellowship from 4 to 8 p.m. though.
4 to 8. Then do it and let's do it tomorrow morning again.
Tomorrow morning I have
Oh,
church.
yes, you have church. Yes. Oh, yeah. So what will be that? Then tonight,
Unless unless we do tomorrow soon after church, like in the
uh,
afternoon.
in the afternoon, I have other things to do, right? That's the only thing with me. Um,
Mm,
tonight, 8 o'clock, you'll be 9 o'clock back, right?
yeah.
Can you do it at 10?
I think so. I should be. I
10.
should be
Let's
fine.
do it 10. So let's try 9. Let's see how it goes. Mine 9, your 10. See how it
Yeah.
goes. If we have to finish somewhere in the middle, we're gonna finish somewhere in the middle, right?
Okay. Perfect.
Okay, let's do it this way.
Okay.
Okay.
Sounds good, Yvette.
Okay.
Okay. Thank you.
Thank you.
Talk
Thank
soon.
you. Sure. Thank you. Bye.